Hi, welcome back. How are you doing? Hope you're doing well. So you're back here for your session on corporate finance. You're actually making really good progress, I must say that, given that you've covered all the last, 8 to 10 sessions, and you are really comfortable by now in the fundamentals of a company and fundamentals of how to analyze a company's three financial statements. So you probably already realize if you work for a financial services company, or if you probably do a finance role in a non-finance company, you probably already realize that you can better understand the decisions being made. You can also better understand your specific role in a larger perspective on the impact on the company's balance sheet or income statement. What I'm going to do in this session is I'm going to take your already good understanding of corporate finance one step further, and I'm going to expose you to this special kind of long-term investment a company makes called Capex, or capital expenditure. And I'm going to also walk you through how this expense item is treated slightly differently than your typical operating expenses on your income statement. Now I'm going to go back to a Domino's example, and the reason I keep going back to Domino's Pizza is that the goal is that by the end of this class, you're really familiar with one company, which in our case is Domino's, so you can just dissect it, from like top to bottom. And once you can do that with one company, you will notice that it's fairly straightforward to do that with every other company. So back to our Domino's example. Now, when Domino's is going to be set up in a new country, or maybe a new store is going to be set up, Domino's makes a lot of upfront investment in stores, furniture, interior decoration, baking ovens, refrigerators, stocking godowns, inventory holding centers. A lot of these upfront expenses, which are different from the expenses to make and sell the pizza, right? These are upfront expenses even before you actually start making the pizza. Now, the difference between these expenses is that the benefit of these expenses is felt over a long period of time. You buy an oven this year, you're not going to throw it out next year and buy a new oven next year. You'll probably upgrade this oven in 3 years, but you'll probably keep the oven for like a couple of years, 3, 4, 5 years. Same thing to do with the furniture and things like that, right? So unless for whatever reason you're in the business of throwing out your furniture and refrigerators every year, I don't know why you would do that. But yes, so such expenditure which have a long-term benefit for the company are typically what is called Capex, or capital expenditure. And the reason they're called Capex, or capital expenditure, is because they are what is called capitalized on the balance sheet. So this is the Domino's balance sheet that you're already familiar with. We looked at it a couple of classes back. You see this first line item right there. It says gross block, right? That is essentially Domino's capitalized expenditure. That is essentially the investment Domino's has made in all these stuff I told you, the ovens, the refrigerators, the furniture, and they have not added it as an expense on their income sheet that year itself. And the reason they have not done that is the same logic we used a few classes back, where we said on an income statement the expenses should match the revenue. So if they've added let's say they bought an oven for 5 lakhs, if they made the entire 5 lakh as an expense on the balance sheet, that would mean that that oven is not going to be used in the next year. But that's not true. You know that an oven is going to be used for many years. So they will divide the value of the oven by the lifetime in which it's going to be used, and kind of use that expense across the lifetime, and we will get to that. But essentially, Domino's capital expenditure, or Capex, can be found in this line here called gross block. Yeah, and that is one example of capital expenditure. And the restaurant industry is kind of a Capex intensive industry, but it may not be the most Capex intensive. There are some industries, like right here you go, the oil industry, right? It's immensely, hugely Capex intensive. Before you can actually even start an oil project or an oil refinery, you probably have to sink in 500 crores or 600 crores for all these huge pipelines, your refineries. You probably have to build a port to take your oil, and if you're drilling oil offshore, you probably have to pay advance to rent those huge oil rigs, helicopters, things like that. So setting up, so which is why every time you read about Mukesh Ambani and Reliance Industries, right, the Krishna Godavari Basin project and all that, the numbers thrown out are like 8,000 crores, 10,000 crores in capex investment before they actually see 1 rupee out of that projects. So oil is a hugely capex intensive industry. Another example is right here, a car industry. Yeah, a car industry. Imagine you want to start making cars, right? I mean, I don't even know where I would start. I don't even know what is the first thing I have to spend on, right? You need this huge factory. You need to invest a lot into R&D, coming up with the design. You need to invest like hundreds of crores in robos before the first car actually comes out of your line. And this is one of the reasons why you never see startups. You know, a first-time entrepreneur, you rarely see a first-time entrepreneur setting up an oil refinery or setting up a car factory. Even something like a car factory, you know, look at all the cars we have in India, other than the Tatas, which is, you know, arguably an Indian-based company. Every other leading car company in India has got some kind of, you know, Japanese or Korean or American or German or Russian collaboration to it. And a lot of times it's because of the technology involved and also because of the huge amounts of capex needed. Okay, another example of this is the industry where Airtel and Vodafone and you know, Reliance Telecom are in telecom. You need thousands of crores to buy spectrum from the government. You need another thousands of crores to go build towers like that. You need another like few hundreds of crores to get your networking architecture, infrastructure, all that in place, and all that is capex. But just because these industries have huge capex does not mean they are bad businesses. It just means that the value of this investment is going to be seen over a longer period of time. And how that is essentially done is, we're gonna look at that. Okay, sorry. All right. So that is the capex of Domino's.